Welcome to BD Daily Finance News Podcast, your daily briefing on finance and investing. It's 2026, January 28th, and today's market story is basically a three-course meal: AI chips, the Fed, and gold.
3 courses? Great, because my portfolio has been emotionally eating. Is the appetizer tech rally, the main Fed anxiety, and dessert gold at $1 million an ounce?
That's the menu, and we'll keep it actionable. What happened, the simple finance behind it, and what it means for normal people. Your 401k, your cash savings, and your risk controls.
Okay, hit me with the chip story. I saw headlines like, China approved Nvidia H200, and my brain immediately went, so we're friends again?
What happened? Multiple reports say Beijing has begun approving imports of Nvidia's H200 GPUs, easing uncertainty for China tech giants who need advanced chips for AI workloads. The key nuance: access may still be tightly controlled for state-backed firms, but big private tech names are expected to be early recipients.
So it's like letting some people into the VIP line, but the bouncer is still side-eyeing the group chat. Why does the market care so much about one chip model?
Simple version: GPUs are the picks and shovels of the AI gold rush. If you're running big AI models, you need massive compute, and Nvidia's high-end chips are a bottleneck. When a bottleneck loosens, it can change revenue expectations, supply allocation, and the whole AI trade sentiment.
If the world is building AI skyscrapers, GPUs are the cement mixers. And if China can buy more cement mixers, the mixer company stock goes, wee.
Why it matters for normal investors. This can extend the runway for the semiconductor-led rally, but it also adds headline risk. Policy can giveth and taketh away. Actionable takeaway: if you're concentrated in AI megacaps, consider position sizing rules, like capping any single stock or theme at a percentage of your portfolio, and avoid chasing gap-up moves on one geopolitical headline.
Enjoy the rally, but don't build your retirement plan on the emotional stability of international chip permissions.
Exactly. Now story 2, the Federal Reserve meeting. Several previews say the Fed is expected to hold rates steady after cuts in the latter half of 2025. The bigger issue is the atmosphere, public and political pressure, and questions about how independent the Fed can remain.
I love when the no-drama meeting comes with a side of institutional crisis. What does Fed independence even mean for somebody who just wants their mortgage rate to stop doing parkour?
Simple version: the Fed is supposed to set interest rates based on inflation and employment data, not election cycles. If markets believe policy is being steered by politics, investors demand a higher risk premium. That can mean higher long-term yields, more volatility, and a weaker currency, because trust is part of what makes money and bonds work.
So it's like if the referee starts taking calls from one team's coach. Even if the calls are technically correct, everyone starts yelling and the game gets messy.
Exactly. Practical impact: if you're shopping for a mortgage or refinancing, the long end of rates is sensitive to credibility. For investors, the playbook is boring but effective. Keep a cash buffer, avoid over-leveraging, and if you hold bonds, understand duration. Longer duration bonds swing more when yields move.
Speaking of credibility and swinging, gold. I saw a headline that gold surged and the dollar got smacked around. Is gold just the emotional support animal of finance?
What happened? Gold has been ripping to record levels, with reports citing dollar weakness, central bank buying, retail speculation, and policy uncertainty, amplified by public comments framing a weaker dollar as great. Ahead of the FOMC, that's gasoline on the hedge trade.
So the vibe is, if the dollar is doing the limbo, gold is doing a victory lap. But for regular people, should we be buying coins, or is this where people get wrecked chasing shiny things?
Simple version: gold tends to benefit when real yields fall, the dollar weakens, or uncertainty rises. But it's not a cash flow asset, no earnings, no coupon, so timing matters. Actionable approach: treat gold like insurance, not a lottery ticket. For many diversified portfolios, a small allocation can be reasonable, but chasing parabolic moves increases drawdown risk.
Today's theme is basically policy headlines are back in charge. Chips can rally on approvals, bonds can wobble on trust, and gold can sprint on vibes. My actionable step is stop doom scrolling and start rebalancing.
Quick recap. Story 1. Reports of China clearing Nvidia H200 imports could support the AI trade, but raises policy whiplash risk. Story 2. The Fed likely holds steady, but independence perceptions can move yields and the dollar. Story 3. Gold's surge reflects weak dollar talk and uncertainty. Use it as a hedge, sized sensibly.
And if you're listening like, cool, what do I do tomorrow? My vote? Write down your max position size, your cash target, and your no trading on one headline rule. Future you will send a thank you note.
Subscribe for your daily briefing and share this with a friend who thinks the Fed is a clothing store. Leave a comment. Are you watching semis, the dollar, or gold into the decision? We'll be back tomorrow.